Guys, it's Dan here. In this week's episode, let's try to answer the question, how is a stock price determined? To do so, of course, we have to talk about market capitalization, because market capitalization is basically the end result of the stock price, and of course we will talk about it. Then we'll have to talk about private versus public companies, because there is a difference in how both are valued. And then we also have to talk about primary versus secondary markets, because again, the valuation is different in the primary and in the secondary market. So a lot of stuff on our plates. All that being said, ladies and gentlemen, let's roll. Okay, so now how is a stock price determined? Well, it will really much depend on the concept of market capitalization. So what does it mean? Well, first of all, how is market capitalization calculated? Basically, it's made out of two elements. The first element is the stock price, and the second element is the number of stocks. To give you an example, imagine if my stock price for one stock is $100, and if I have 1,000 stocks in my company, it means that the market capitalization in this case will be $100 times 1,000 stocks leads to $100,000 in market capitalization. So now sounds pretty fancy, market capitalization, but what is it really? Well, basically it means value of the company. To give you an example, if you want to buy Apple, imagine if you are extremely wealthy and everything goes right, in theory, and if you want to buy Apple today, you can Google the market capitalization of Apple and you will see that it's the most valuable company in the world right now. The value is about $2.2 trillion. So that's the money you need at least to buy Apple. To go a bit more into detail, let's go back to this example. Here, as I just mentioned, the market capitalization of my example company is $100,000. So the value of this company is basically $100,000. So imagine if I want to sell this company and if you want to buy it, well, you will pay probably at least the market capitalization, which is $100,000. Of course, it's always a negotiation, but that gives you a very good ballpark number. And what happens usually when someone wants to buy a company, let's say a new investor wants to buy a company on the stock market, let's say New York Stock Exchange or something like that, what will happen usually to make sure that all the investors are selling, the new investors will not offer $100, but they will offer a premium, probably up to 20%. So they will try to go into the negotiation maybe offering $110 and then maybe $120 until all the investors sell. And this will make sure that the new investor gets the company for about $120,000 in this case, which would then be the new value of the company. So now what I wanted to also tell you, because that's very important to understand with these two elements, is of course there is a lot of regulation, especially on the stock, on the regulated stock exchange. For example, you have the New York Stock Exchange, which is the biggest stock exchange in the world, and they have fixed a few rules. So the first rule you have to know, and of course it's going to depend on different, it's going to be different for each country and each stock exchange. But on the New York Stock Exchange, for example, the minimum stock price to be listed is $4. So you cannot sell shares for, let's say, 50 cents or $1 or something, because you need at least a stock price of $4. And the market capitalization of the company you are listing on the stock exchange has to be at least $40 million as market capitalization. So as we're talking bigger companies, of course, here. So that makes it obvious that, I mean, if the share price is $4 and if you need a market capitalization of $40 million, then you need 10 million shares in this case. $4 times 10 million shares lead to a market capitalization of $40 million in this case. So now you have a broad picture of market capitalization and the different elements and the different regulations. But now I would like to tell you something. Don't make this stupid mistake, because a lot of people are focusing on the stock price, and this tells them the value of a company, which is totally wrong. I give you an example. For example, Which company do you think is more valuable on the stock exchange? Do you think it's Apple or do you think it's Tesla? I'll give you an example here. The Apple stock price right now is at $133, and the Tesla stock price is much higher, is at $680, so at least 3 times more than the Apple stock price. But that of course doesn't give you the entire picture because it's just one element. Here it doesn't mean that a higher stock price means a higher market capitalization, because of course it will depend on the number of stocks that are available. So to finalize my example with Apple here, they have a stock price of 133, but they have a huge market capitalization of 2.2 trillion. Compared to Tesla, for example, Tesla has a very high stock price of 681, which is 3 or 4 times higher than the Apple stock price, but the market capitalization is only, and I quote, only 657 billion, which means it's about 3 or 4 times smaller than the one of Apple. So this again is just an example to showcase you that the stock price doesn't mean much, but that the market capitalization is the most important here, because it takes into consideration the stock price times the numbers of stocks. So that's the first thing you have to know. So now I would like to give you a real life example to show you how the stock price, how the number of shares, and therefore also how the market capitalization evolves over time, okay? So first of all, what you have to understand is there are private companies and there are public companies. Each company that starts in their own garage and stuff like that is a private company, okay? That means that either only the owner invests inside the company, or that there are some funds that exist that only invest in private companies, okay? For example, every private equity company, venture capitalists, seed funds, and all these things invest only into private companies. And at some point, when the private company is big enough, they will go public, which is usually the goal of a company, because they are getting powerful, they are getting big, and then they are becoming a public company, which means publicly traded on a stock market, and which means that the public, such as you, such as me, can buy shares of these companies, and of course all the big asset managers, pension managers, and all these things, okay? So now let's walk through the example and you will see how the valuation and how the stock price changes. So first of all, let's start here with the left. Of course, when you are creating a company, it's a private company. Imagine TikTok a few years ago. TikTok is still a private company, that's why it's a good example. And of course, when you're setting up your own business at the beginning, the stock price, of course, is zero at the beginning. Your value, you have not created any value just because you have an idea. So maybe you have a product or service, but at the beginning, of course, the stock price is zero because your company has zero value, right? Then imagine the number of stocks, and you have decided with the 4 other owners of the business, for example, that each of you should have 250 shares or 250 stocks. That's the same. So the number of stocks would be 250 times the 4 owners leads to 1,000 shares at the beginning, okay? And of course the market capitalization, which is the stock price, $0 times the number of stocks, 1,000 stocks, leads to, of course, a market capitalization of 0, because it's 0 times 1,000. Makes total sense. At the beginning, when you are creating a company, of course, the value of the company is 0. Makes total sense, right? Then imagine it's a great company, it's running great, a lot of interest, a lot of sales and stuff like that, and you're doing a first funding round, pitching it to investors who are very interested in your product, everything is doing well. And then, so yes, there is the first funding round, and you have agreed with your investors that the stock price is 100. As you can know, as you see, it's always supply and demand and negotiation, of course. So you agree to sell a part of your business to new investors, first round investors, for let's say $100 per share. And you keep your 1,000 shares, but you are giving out 1,000 new shares to the new owners, of course, so the pie is getting bigger, which means that the market capitalization now is the stock price 100 times 2,000 stocks leads to a market capitalization or value of the company of $200,000. You are continuing the same process. Imagine 2 years later, you are still growing, you need more money to expand, everything's going well, you're selling products and all that kind of stuff. Second funding round, and now imagine now the bigger private equity investors come in, they see there is a huge chance that you're gonna make it, you know. So they want to buy your stock at $500, imagine. So you see, you went up from 0 to 100 to 500, so now you are getting interesting, right? And the number of stocks, of course, is also getting up because you are always putting out new shares that you are selling to new investors, because so the pie is getting bigger on the private market right now. Okay, you have sold some shares for $500. You have sold in total now there are 5,000 shares in the business. 500 times 50, $500 times 5,000 shares leads to $2.5 million market capitalization. So basically $2.5 million of value of your company right now. Now the big time. Imagine fast forwarding, you are big enough to go public. The big day, right? So you are doing what is called an IPO, initial public offering. And an initial public offering is always led by a big investment bank such as JP Morgan, for example, Goldman Sachs, you know, the experts in going public. So what is happening here is that during an IPO, these specialized guys, they will meet different kind of clients who they know they would be interested in your business, and they will do what is called a roadshow. So meaning that they're pitching your new company with the story and all that stuff to the new investors who would be interested in buying your shares once the company goes public, of course. And this is where they get a good sense, and of course with all the experience, how much they could charge per share, and how many shares should be given out to the public. So this is kind of again a negotiation, but with a lot of experience here. So the investment bank will do the math and all that stuff, and they will say, imagine there is very good demand. Your book is what is called oversubscribed, which means that a lot of people want to buy your shares, right? More than expected. And in this case, imagine the stock price has doubled basically from the second funding round, which was $500, to the initial public offering. And now you're offering your shares for $1,000 per share. And you are offering a total of 50,000 shares, which leads to a market capitalization, a value of the company of $1,000 times 50,000 shares leads to $50 million. So right now that's the value of the company. And what is important to understand is the day you are doing the initial public offering, so the day you are going public, that's called the primary market. Okay? Primary market because it's the first time public investors can buy your shares. The first time, that's why it's a private, that's why it's called primary market. Okay? And then everything, what happens after that is going to happen on what is called the secondary market. This is all the stock market, it's just called differently because here the public investors buy the shares for the first time, and then on the secondary market there is just an exchange of old shares. So for example here, imagine if BlackRock bought some shares at the initial public offering day, they will maybe sell them a month later, and the price will of course change. And what is important to understand is once that the company went public, imagine Airbnb for example that went public in 2020, the price, the share price will depend on supply and demand. If there is a lot of demand, a lot of people want to buy Airbnb shares, for example, the price will go up and up and up and up. That's what we have seen basically with Tesla, because there was a lot of hype going on and then good results and stuff like that. Of course, if there is more supply than demand, meaning if there are a lot of shares outside that nobody really wants, the share price will go down. Usually the number of shares stay the same unless the company buys back some shares, but that's a different topic. What I wanted to finalize the video basically is, as you can see, there are a lot of factors playing in. The stock price, of course, changes over time for sure, and usually it goes up until the public offering and then changes a lot basically, because here there's a lot of hype and then the reality comes in, kind of. The number of stocks, of course, increase as well until maybe the company, when it's public, let's say Apple or something, decides to buy back their own shares because they want to cut the supply. A lot of companies do that once they're public. And of course, the market capitalization, which is really the thing to look at, is changing over time. And I mean, in a very small but successful company, it's going to rise very, very fast at the beginning. And then once the IPO comes, well, it's going to depend. Uber, for example, skyrocketed at the beginning. And since the IPO, well, they're kind of not doing so well because a lot of investors believe that Uber, for example, is overvalued and cannot deliver profits and good results for the future. Well, all that being said, it was a lot today, I know. I hope this was still kind of beginner friendly because we have touched a lot of different things which are not very beginner but still understandable, or I try to make it simple, you know. So if you like that kind of video, if you like corporate finance, market finance content, high value content, I post once a week every Sunday. So if you like that stuff, don't forget to subscribe, of course. Don't forget to like, helps to spread the word, of course. All that being said, ladies and gentlemen, have a great week. Enjoy. Bye bye, guys.